Corning Incorporated, stock ticker GLW, is a multinational materials science company that manufactures specialty glass, ceramics, optical fiber, and related materials. Founded in 1851, Corning is now a $28 billion by market cap materials mammoth that employs almost 60,000 people. The company reports results across 5 major business segments: optical communications, 35% of fiscal year 2022 sales, display technologies, 23%, specialty materials, 14%, environmental technologies, 11%, and life sciences, 9%. All other accounts for the remaining 7%. Corning is an essential player in making various technologies work. We can go down the list: optical fiber for internet access, glass for smartphones, or specialty materials for advanced R&D processes. In fact, there's a pretty decent chance that the glass you're interfacing with right now, in order to consume this piece of investment research that I've made for you, was manufactured by Corning. Corning is a proven leader in specialty materials. The company has demonstrated an ability to innovate and stay ahead of the competition for decades. Morningstar puts it like this, and I quote, "Corning is a materials science behemoth with differentiated glass products for televisions, notebooks, mobile devices, wearables, optical fiber, cars, and pharmaceutical packaging. In its 170 years of operation, the company has constantly innovated, including inventing glass, optical fiber, and ceramic substrates for catalytic converters, and oriented itself toward evolving demand trends that it can serve through its core competency of materials science. Most recently, we point to Corning's domination of the smartphone cover glass market and deals with US network carriers to supply fiber for 5G buildouts as evidence of the pivot toward growth," unquote. What more can you say? Corning hasn't been prospering for nearly 2 centuries by accident. A lot of everyday tech we use and almost take for granted doesn't really exist without Corning's input. And I'm quite confident that the tech of tomorrow, which is even more exciting, will require Corning's input. That's why Corning is positioned so well to continue growing its revenue, profit, and dividend for many years to come. To date, Corning has increased its dividend for 13 consecutive years. The 10-year dividend growth rate is 13.1%, which is strong. That dividend growth rate has also been pretty consistent over the last decade, and you get to kick things off with the stock's market-beating 3.3% yield. This yield, by the way, is 60 basis points higher than its own 5-year average. The payout ratio of 60.1% based on trailing 12 months adjusted EPS is slightly elevated but unconcerning. I tend to like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. We're clearly in the sweet spot here. You're getting a pretty satisfactory amount of both yield and growth from Corning. Looking at business growth, Corning moved its revenue from $7.8 billion in fiscal year 2013 to $14.2 billion in fiscal year 2022. That's a compound annual growth rate of 6.9%. Solid top-line growth here. I'd usually expect a mid-single-digit top-line growth rate from a fairly mature business such as this. Corning did even better than that. Meanwhile, earnings per share grew from $1.34 to $2.09 adjusted over this period, which is a compound annual growth rate of 5.1%. The company's last fiscal year saw unusual restructuring charges, which is why I used adjusted earnings per share. Corning has suffered through some margin compression, which affected bottom line growth. These are pretty decent numbers, but I'd like to see earnings per share growth pick up some. We may have some good news on that front. Looking forward, CFRA is projecting a 10% compound annual growth rate for Corning's earnings per share over the next 3 years. That would be more like it. Some areas of Corning are doing really well, other areas are not. CFRA sums up the lumpiness in growth across Corning with this passage, and I quote, "The company is combating softening demand for smartphones, TVs, and automobiles, but this is offset by content growth of inputs for smartphone cameras, gasoline particulate filters for internal combustion engines, and larger in-cabin displays for automobiles. We are encouraged by investments in fiber infrastructure as operators expand capacity, capability, and access. In addition, we expect life sciences momentum to continue due to strong research funding and lab utilization, partially offset by weak COVID product demand," unquote. The last few years have been especially lumpy, undoubtedly affected by the pandemic, but there's evidence that a bottom is behind us and Corning is on the upswing. The company's most recent quarterly report for Q2 fiscal year 2023 showed 10% year-over-year growth in adjusted EPS. That's precisely in line with CFRA's near-term earnings per share growth forecast. If we take this as our near-term base case, which I think is a reasonable assumption to make, that sets up Corning for like dividend growth. I would actually expect something less than that, as the payout ratio is slightly elevated, but even a high single-digit dividend growth rate is more than enough to get the job done. After all, you get that 3% plus yield to start off with. Moving over to the balance sheet, Corning has a good financial position. The long-term debt-to-equity ratio is 0.5, while the interest coverage ratio is over 7. That latter number was hurt by low GAAP earnings in the last fiscal year, and I'd expect a higher interest coverage ratio in future years. Profitability is okay. The firm's net margin has averaged 7.1% over the last 5 years, while return on equity has averaged 8%. I prefer higher returns on capital, but Corning has done well anyway. Overall, Corning is in an enviable position of being the company when it comes to a variety of specialized materials. And with economies of scale, IP, vertical integration, R&D, and switching costs, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The company faces risks around technological obsolescence, and Corning must continue to innovate in order to stay ahead of the competition. Corning's end markets are sensitive to economic cycles, which leaves Corning somewhat vulnerable to recessions. Vertical integration is an advantage, but input costs are rising. Being an international organization, the company is exposed to currency exchange rates and geopolitical risks. The company is mildly acquisitive, which introduces execution risks. I don't see any of these risks as being overly cumbersome, especially when compared to the total profile of the business. Plus, the valuation appears to be at least mildly appealing. The stock is trading hands for a price-earnings ratio of 18.4. That's using trailing 12 months adjusted EPS. It's a below-market earnings multiple on a peerless business. The price-to-sales ratio of 2.2 is also below its own 5-year average of 2.3. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That's well below Corning's proven dividend growth over the last decade. In addition, the near-term forecast for EPS growth is well above this rate. However, the payout ratio is slightly elevated, which is a result of earnings per share growth over the last decade not quite keeping up with dividend growth. If management is prudent, some moderation in the dividend growth in order to reduce the payout ratio would be wise. Still, a high single-digit dividend growth rate is really not a bad deal at all here, and it's possible that I'm erring on the side of caution, which I'm often liable to do. The dividend discount model analysis gives me a fair value of $39.95. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates GLW as a 4-star stock with a fair value estimate of $39. CFRA rates GLW as a 4-star buy with a 12-month target price of $40. Boy, you won't see a much tighter consensus than this. Averaging the three numbers out gives us a final valuation of $39.65, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Corning Incorporated is an under-the-radar company providing some of these specialized materials that are crucial to making a lot of everyday products work. In some ways, it's peerless, with a market-beating yield, a double-digit long-term dividend growth rate, a reasonable payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 15% undervalued. Long-term dividend growth investors looking for an outside-of-the-box idea have one right here. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, has done it yet again. The company reported a stellar Q2 showing 60% year-over-year growth in revenue and 112% year-over-year growth in adjusted earnings per share. If you're a dividend growth investor looking to play the explosion in demand for lithium, this dividend aristocrat has to be top of mind. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.